Hi everyone, welcome to the free UK stocks to buy January 2021 edition, and this is where I talk about the free stocks that I'm looking to buy in the UK stock market in the month of January. This is the most popular video series that I run on the channel, always brings in some new subscribers, so if you are new, make sure to subscribe. If you are here all the time, you guys smash the like button. A good target for you guys is 300 likes. If we can get to 300 likes, that'd be pretty amazing. And yeah, we'll go through the stocks that I'm looking to buy. There is a good mixture today. We're going for a turnaround play, so a stock that's really been beaten down and is starting to put some of the right things in place to kind of get the company back into a good position. We're going for a growth stock, and also we're going for a bit more of a dividend play. So it's a great mixture really. Yeah, and I'll go through these three companies and why I'm kind of like looking to buy these and where I see them going. But just before I get into that kind of view, first of all, what position is the stock market in? Because I think it's always really, because I think for so long the UK was, I mean, since I started covering UK stocks for the good like 7-8 months, UK stocks were kind of so beaten down and they just weren't doing anything at all. And I even in the comments I had people going, when are UK stocks going to do something? And then next thing you know, we had the vaccine news. I think nearly every stock went up because of that news. And we've gone from companies that have just been dirt cheap prices to a big massive jump. And it's like, it's a lot harder now to buy stocks when you're like, yeah, but I could have bought that company a few months ago and it was nearly half the price. And that's one of the big problems we have right now in the stock market in the UK front, is that you're always trying to think like, but I could have got that so much cheaper a few months ago. And it's trying to change that mindset now of like, right, we're probably actually not going to get them prices again now. So it's kind of getting back to a point of view where like a few months ago, you could have bought anything and it would have gone up. But now we're actually having to look for a few more deals out there, a little bit more trickier, trying to find a good valuation. So yeah, I guess the first thing is like the mentality point of view of this month is a little bit trickier. Now, the other great thing at the moment is there is starting to be a bit more uncertainty trying to creep in. So obviously we've got like, I wouldn't say the Brexit now, that's kind of past there, but obviously we've got these new wave of maybe a lockdown. And if a new wave of lockdown happens, is the stock market going to go lower? I'm at the point of view where I do see that if there's a lot more uncertainty, lockdowns for example, that could shape the market a little bit and we could see, you know, something like a 5% drop or something like that. But we'll never get to a point where we were at, 6 months ago, because when we look at the market, it's always future thinking and it tends to think about 3 months ahead. So you look at 3 months ahead and, obviously that puts us towards springtime, and springtime we should have a good vaccine rollout and we should see things slowly creep to normal in a few months time. It probably won't be, back to normal exactly how we want to remember it in 2019. Well, I'll say 2019, the start of 2019. It was pretty much 2019. It was 2020 where it all went downhill for all of us. But yeah, I think that when you think about that, I think that's why the stock market isn't getting, the UK front isn't getting shaken that much really now by a lot of this. I think it's kind of like we're nearly there. We're nearly at the vaccine rollout. So yeah, I guess that's one of the big parts, is like looking at the valuations now and trying to change the mindset of like the bargain prices are certainly gone now anyway. So anyway, that's where I'm at with the stock market. It's definitely a lot trickier than what it was a few months ago. It is a bit harder to find a few bargains out there, but we'll take a look at these three companies. And if you could, like I say, smash the like button if you are new, make sure to subscribe. And if you do want a free share and you are looking to get into investing, there's a free trade account and a trading 212 account in the description. You join through there and set up an account, you get a free share. But we'll get stuck into the free stocks. So number one is the turnaround play in this portfolio, which is Card Factory. Now this is coming up to a major earnings report now for Card Factory. I think when we do get the earnings report, it's pretty much going to be when we see a lot of these Christmas sales, it'll be a very big, I think the stock will move quite a bit. And that's the key thing. When we get into the next one and we see, how well it managed to do with them few days it had open over Christmas, because that's where a lot of its sales come from. That's going to be a key part of it. And obviously it's a turnaround play. So I guess the first thing before I even get into like the fundamental side of it is like, why do I think this company's got to turn around? Because if it's in a bad situation, there has to be positives. It needs to change what it's doing, otherwise it's going to have a bit of a horrible future. So first of all, like if I was saying like, why is this company in a better place than what it was 12 months ago? First of all, there's been some new deals. So one of the new deals it has is with the Reject Store, which is 300 Australian stores. So if you imagine now, if you're in 300 new stores in a new international country, that's only going to add to your profit and revenue side of it. So I'm hoping that when we see some of the Reject Store sales come into this, it should see revenue and profit go up. And if revenue and profit tends to go up, the share price tends to go up. So I'm thinking, first of all, that's a really positive deal that it's got in place. So that's one thing. Next thing is that it started growing its online presence a lot more. So obviously we know about Moonpig and everything like that, but Card Factory has been a bit slow upping its online game. And it's finally done it. It's rebranded its website. It's got another website which is called Getting Personal. So there's 2 brands that it has online, and Getting Personal is growing quite a bit. The Card Factory online is doing pretty good. I think the last update we got in the earnings report is that sales grew, I think it was 60 or 70%. So that's really good. I am going to say one thing I would like to see management do is probably market a bit better. I think that they need to market that they're online now a bit more. That's one little thing I would say that they could be doing in the next few months, what I'd like to see. As well as that, I like the reject store. I'd like to see them in, the Card Factory is maxed out in the UK, like literally, like you go to any town or anything like that, there's a Card Factory in every town. Like there's not much more. Like they can't go around the country going, oh, there's a gap between this place and we'll squeeze one in the middle. Like you're probably just going to end up taking business away from both locations to squeeze this new location in the middle. Like in my point of view, Card Factory has to get like bigger now outside of the UK. Like I think they've done as much as they can in the UK apart from online growth. I think the next thing is like the Australian deal with the reject store, and that's obviously a big thing that they obviously need to ramp up on. But other countries as well, like other dominant English speaking countries, that's where they need to look to expand to as well. So that's another thing as well. So that's another 2 things. They also had a new deal with Aldi. So Aldi is obviously a very popular supermarket. Because of that, sales have still been able to happen when they've been shut. Card Factory stores have been shut. So yeah, that's another thing that hopefully really pays off for them. And any sort of lockdown as well should be okay because they'll still get some revenue from that point of view. So those are some of the catalysts that have really helped it. And the other catalyst as well, could be a catalyst, is they've actually finally brought in a new CEO. So obviously the big thing is that the management has been awful in the company. That's why the company has struggled to grow revenue that much. It's struggled to grow profit much. It's not developed, and because of it not being developing, that means it's been shareholders have gone away because it's not increasing its profit or revenue. But now with the new CEO in, I think the CEO appointment was about as good as what they could get, to be fair. Obviously, Card Factory isn't going to pull in, Elon Musk, for example, but obviously the new CEO hopefully has a few things to turn around, and hopefully they'll watch this video and they'll listen to me and start pumping that online sales a bit more, and also look to expand internationally. That's where I'd like to see the company go. But I think when you look at the company where it was at only a few months ago, a few years ago, it hardly had an online presence. It didn't have the 300 Australian stores. So I think that is 2 key things that are really going to help it. And you could even argue the Aldi cards as well. That's another thing that they've grown as well quite a bit. So I guess that's kind of the turnaround side of it. From a fundamental point of view, the valuation is really dirt cheap. Like obviously you look at the chart. The chart has just fallen off a cliff. It's since it came onto the stock market, it's been downtrending for so long. But that's just because there's been no positive news. The revenue growth's not been good. The profit's not been good. So yeah, I mean it's been downtrending, but hopefully the revenue and profit increases with these turnaround things that I've said earlier about it. And when you look at the revenue and profit side of point of view, you can see that it's just hardly growing. It's not attracted investors in. Why are you going to invest into a company that isn't growing revenue and profit? So yeah, that's another thing. I guess the balance sheet kind of view is one thing as well that isn't amazing, but that's all because of the company being mismanaged over the last 3-4 years. So hopefully that can sort out. I mean, this company was paying a bit of a dividend. I am hoping Card Factory actually don't bring their dividend back. I would prefer it that they just sort out the balance sheet a little bit before bringing the dividend back. And yeah, I think hopefully if they can increase the profit, then obviously that will help to pay the debt off, and then eventually they can come back to the dividend. So I hope that don't come back straight away. Another positive is that some insiders are buying in the company. I believe it was the CFO bought a lot of shares in October time. So that's a little bit of a positive, and obviously they have a good understanding of the finance side of it as well. So that's a little bit of a bonus in there. And let's not forget the valuation in general. Like this company is massively sold off. I think if the company went to do the revenue it did in 2019, this company is currently trading at a P of like 2. And I don't think I've ever seen a company trade at a P ratio of 2 unless it's like pretty much going to go bust or something. Like a P ratio of 2 is obviously crazy low. And I think even now, like it's trading at a P ratio of like 10, and that's considering like half of the COVID numbers in it. And as well as that, I think the company's market cap of like 100 million, and the revenue is like 500 million in 2019. So yeah, the revenue is 5 times the market cap. So I don't think I've ever seen that valuation from that point of view as well. That's absolutely crazy as well. So yeah, I think this is a very, very sold off company. And even if it didn't have this turnaround plan in place, I would be probably tempted to maybe consider buying this one just because of how sold off it is. But as well as that, it has got a solid turnaround plan in place. So that makes me really confident in this one. I don't want to make it a major position just in case something did go wrong with the company because of it being a turnaround play. Like, I don't want a turnaround play to be my number one holding, but I definitely can see myself buying a few more shares. And like I said, the key thing will be the next earnings report, because we'll start getting some Christmas numbers in there, online sales in there and everything like that. So yeah, I think overall it's definitely a really interesting one, and I could see myself in the month of January increasing my Card Factory position by about 10 or 20%. Number 2 is my new growth stock that I've been buying, and this could actually come to probably my 4th, 5th, 6th, somewhere around there, biggest position in my UK portfolio. And this is S4 Capital. Now this company for me is definitely a very cheap growth company. When you look at the growth they're putting in, the profit they're putting in, this company does seem very fairly valued. I've been looking at a few gaming UK stocks recently, and I've been looking at their growth and like, yeah, it's pretty good, but these sort of companies are trading like over 100 P ratios. And I'm looking at S4 Capital, and I don't like buying at 52 week highs. I hate buying at 52 week highs, because if you buy at 52 week highs and something goes wrong, you're the first ones that get stung and you go down on your position huge. And I normally avoid, like, even the companies that I really like that are on them sort of like uptrends, I at least wait for like a 5% pullback or something. With S4 Capital, there has actually been a little bit of a pullback, but nothing crazy. And it's probably for me, one of the most attractive companies to buy at the moment on the stock market for the UK side of it. And as well as that, it's very exciting on the growth side of it. I can see this being a very good performer over the next few years. And the great thing as well is S4 Capital is a very new company. And when you consider like how much growth it's had in them few years with it being a new company, is amazing. And S4 Capital actually brought out some amazing numbers in its earnings report. And you think about what scenario that was in. Like, S4 Capital brought these out when it was like COVID. And you think about the companies it works with, them companies, the first things they were doing was cancelling any hiring, anything like that. It weren't hiring anyone. Cutting back as much as possible. And one of the big things that it was cutting back on was marketing budgets. Like, let's stop marketing. And obviously, if S4 Capital's a marketing company and it was still pulling out amazing sort of revenue and profit, think about now that if they did that with a lot of companies cutting the marketing budget, think about in the next 12 months if a lot of these marketing budgets come back, and then you start thinking about what numbers S4 can do. It seems pretty exciting, really. So I do like it from that point of view. So this company trades at a 2.6 billion market cap, so it's a pretty decent sized company for a UK company. Like I say, on the stock chart, it has had a very decent run. It's just had a slight pullback recently, and this is where I've been buying quite a bit. Even on Simple Wall Street, to be fair, this company is still classed as being undervalued for a growth company, which, like I say, you don't really see it too much on Simple Wall Street. And on the earnings and revenue growth, you can see how much the revenue is going to be growing. It's like nearly a 50% rate. Even the profit's growing at a really good rate as well. So, this company the valuation is going to drop huge on it because of the profit growth, and the revenue growth as well is going to be amazing. I mean, you look at this company right now, and it's pulling in some fantastic revenue growth. Like, I think this year it's predicted to do about 338 million in revenue. So when you look at the market cap size of it, it's actually not a crazy sort of valuation, like on a price to sales ratio. So that's really attractive on that point of view. You look at what the company is like health-wise, financial-wise, the debt to equity is only 14%. So it's a really healthy company as well. It's sitting on 85 million cash, 77 million debt. So pretty happy on that point of view as well. And when you look at the insiders, there's not huge buying, but there's been quite a bit of buying as well, which is also a positive in the company. And also there's been quite a few like little institutions buying as well, which is also really positive as well. So yeah, I guess everything from that point of view is really healthy. So for me, S4 Capital, a great growth company, could be a company that I just sit on for quite a few years. And I think that realistically, if it's going to be growing the revenue at what it is and the profit is going to be doing, in my opinion, this stock could be 100% return in the next 2 years, and it could even be a multi-bagger, I think, in the next few years even after that if it carries on this growth. So yeah, pretty happy with that one. And number 3 is a dividend stock, but I also think there's going to be some good share price in here, which is Airtel Africa. And this had a recent drop last month. And yeah, I mean, originally I was collecting a nice dividend. It had some nice share price gains. I was like up 40% on it. And then all of a sudden I've dropped down to about only 10-15% up on it. So it has had a major drop. And yeah, I think if it stays around this valuation, or if it can have another about 5% pullback, I probably could add into this one a little bit more. But yeah, Airtel Africa is a telecoms company that is based in Africa, hence the name. It also has a bit of involvement in the payment area as well in Africa as well. So I like that it's in a lot of countries that are developing at the moment, and a lot of these countries are only just about getting like 4G coverage. So you think about there's the 5G coverage cycle to happen still in Africa as well. Like that's still quite a few years off, because at the moment a lot of African countries are still doing this 4G cycle. So you think when that's done, then they're going to benefit from the 5G cycle. So that's a great thing as well. As well as that, involved in the mass and everything like that to get the coverage. Payments, obviously there's not too much payment coverage as well in a lot of African countries. So these guys being like a bit more of like a PayPal in Africa is a great benefit from them. So I think they'll benefit from, they've still got a lot of growth to happen, and they're in growing industries, which I really like. So I think the revenue and profit's still going to grow, and at the same time I'm still going to just sit there and pick up a dividend, which is really healthy. So the share price had a drop recently, and that was due to a mystery seller who sold a lot of shares, and it kind of got there in the news and everyone panicked, and yeah, the stock had a massive drop, and I think it will recover it very soon. But yeah, I think from that point of view is like, is it really anything that's changed the company? Like someone selling shares, is that a reason for the share price to drop as much as it did? Probably not. So that's what we've got to consider. Is this a good opportunity to go buy? And that's the main thing with this company. So it's a 2.8 billion market cap company. Obviously on the stock chart you can see where it does have a little bit of a dip. Funny enough, this company is 80% undervalued on Simply Wall Street. Not sure how correct it is, but yeah, you look at the P ratio, very cheap company. Trading at a P ratio about 14 is definitely something quite cheap. You look at the revenue growth, it's always growing the revenue at a very steady rate, which is really, really positive. The profit had a little bit of a sink down, obviously due to COVID in 2020, but historically the profits moved in the right direction as well, which is also really good. So yeah, I mean, it's not a growth company, but as something that I'm looking at as a dividend company with a little bit of share price gain, you can see that it's definitely got that potential. Now on the balance sheet, this is the only thing that is a little bit of the only negative I've got to say, 100% debt to equity, but it has been getting a lot better. It's got 3 billion in debt and 1 billion in cash, so yeah, that's only something to be careful of, but if it carries on making the profit that it's going to do, then obviously it can look at paying some of that debt off. And yeah, at the moment it's currently forecast to do a 2.9% dividend yield, but it's been a bit everywhere because of the COVID and everything like that, and it depends on what price you buy it as well. So one thing that they did actually do is they cut the dividend. So yeah, I mean, I feel like that probably will come back soon. But as well as that, obviously buying down at discount prices, you also get a higher dividend yield as well. So yeah, I feel like at some point that it will be okay, and it will come back. So it will do quite well going forward in the future. And there's not really many insiders to talk about. It's pretty quiet on the front of the insiders. So those are the 3 UK stocks to buy, January 2021 edition. Hope you enjoyed it. Like I say, very big coverage here, turnaround play, growth stock, and a bit of a dividend play as well. So hopefully you enjoyed it. As always, if you smash the like button, if you made it all the way to the end, make sure to subscribe, and I'll see you next video.